thanks very much, everyone, for joining what is a topic that's quite kind of one of those topics that I'm quite passionate about. And I know it's a bit of a buzz thing at the moment. I'd like to say that it's been something that I've always been very interested in, and it's actually become a bit more of an option from an investment perspective. So I wanted to pull together today a bit about what is ESG investing, and kind of an investment approach around the ESG, and how you can align, I guess, what you may actually have in your beliefs and your passion, and align it to your investment strategy, so that you've got, your alignment between your investments and your values as well. So thanks very much for coming today. We're going to now, just on our important information, so that you have all the fine print. Obviously today is going to be general advice. It's not personal advice. So if there's any questions that you have, or you want to actually look at this more from a personal perspective, please do get in touch with us as well. So just to introduce myself, actually there's a number of names that on today that I actually haven't met. So my name's Shannon Smith. I'm the founder and managing director of Smart Business Solutions and Smart Private Wealth. My background is an accountant, also a financial advisor and a mortgage broker. And I've been really looking at the ESG space for quite some time. It has always been something that's been a really big interest of mine. Always doing things for the benefit of the community, but also what we can do with our environment, our footprint. If we look at our building at Smart that we built, we put a water tank under the car park. So we're fully self-sufficient on the water. We have solar. So actually our electricity bill is about $100 a quarter because of our solar. So there's a lot of little things that I've always had an interest. But the ESG on the investment side was not always something that it wasn't always giving the returns that people would want. So whilst it may have been something I was quite passionate about, it wasn't always giving the returns. But we are seeing such a big change in that kind of space as well. So today, though, I'm not going to be doing all the talking. Actually, Bianca is a licensed financial advisor. She started with us actually as a vet surgical nurse, as most financial advisors clearly start as a vet surgical nurse, but and in administration, and really found a passion for financial planning. Fast forward a number of years, masters in financial planning. Bianca's a financial advisor. Also, both of us have actually undertaken an ESG accreditation. So it's the only one of its kind. That was additional study that we have done just to really kind of get ourselves. And it is an area where, as a firm, we would like to actually focus a lot more on it. There's a lot of discussion around the topics, and also the greenwashing, which Bianca will go through. So what we want to go through today: what is ESG investing? Not just about all the buzz or people saying, because it sounds like it's in vogue to say, oh, I'm doing things environmentally friendly. Like, what does it actually really mean? What is the overall impact of ESG investing? And I really love this part of it, because the impact now, you can really see the positive impact that you can actually make. And I don't think we had that in prior years. What do we look at when we look at investment screening? And then what is greenwashing? And it's one of those very frustrating things. And there's a lot of different companies that are getting a bit of trouble on that. So we'll touch on that. And then risk return and reporting, and how does that all come about? And then what can you do as a next steps from an ESG perspective? So I'm going to hand you over now to Bianca to go through ESG, or our interpretation, I guess you could say, the practical guide to ESG investing.
Thank you, Shannon, for that smart introduction. ESG investing, so it can mean an array of things. So it can include when a fund considers sustainability, including environmental, social and governance factors, to prepare their investment strategy. And there is definitely a growing demand for ESG investing. It can also be known as sustainable investing, or sustainability related investing, responsible investing, or also known as ethical investing. And the way ESG investing is defined may differ from fund to fund, and also may differ from person to person as well. So the ESG in ESG investing stands for environmental, social and governance. And ESG investing can include directing capital away from harmful sectors and towards smart businesses doing good for the planet, people and animals to help create the equitable, sustainable world that we all want to live in. So ESG investing can also include investing in companies that you do not want to, that you do not agree with their values, to be able to influence them to do better. So ESG investors invest in this way, not just because it's the latest trend, as Shannon mentioned, or because it's in vogue, but because of, you know, their individual values, the fundamental sustainability of a company, and also how a company cares for its stakeholders and the world around it. So if we have a look at the E in ESG investing, which stands for environmental, this can include many factors, and some of these can include air and water pollution, biodiversity, carbon emissions, clean technology, climate change, deforestation, energy efficiency, sustainable agriculture, waste management, and also water scarcity. The S in the ESG stands for social, and social areas can include child labour and labour standards, community relations, diversity and inclusion, ethical product sourcing, gambling, human rights, Indigenous reconciliation, tobacco, controversial weapons and firearms. These are just to name a few of the examples. The G in the ESG investing stands for governance, and that can include the following areas and many more, of course, but it can include investment of companies involved in supply chains, board diversity, bribery, corruption, the ethics of business, corporate culture and conduct, tax strategies, and also corporate risk management. So demand for ESG has largely been client-driven. And if we have a look at the research from RIA, which is actually the Responsible Investment Association of Australasia, they have suggested that Australians are overwhelmingly concerned about how their capital is invested. And if we have a look at a report, oh, sorry, I'll just go back, I'll just skip the slide there. Oh, sorry. We have a look at the report from 2022, RIA's Values to Riches report. It actually revealed that 83% of consumers expect that their banks and superannuation to be investing responsibly and ethically, with 80% of them expecting their savings to have a positive impact on the world. So greater transparency to us means greater choice. And what ESG has largely done is demonstrate that investors have a choice of which causes their money supports while they are investing it. So it is a far cry from the baby boomer era, whereby money was placed in shares with little to no insight into what their money was actually supporting. So if we have a look at the top environmental themes in 2023, according to the RIA report, renewable energy and efficiency is 53% in the top themes for environmental. Sustainable and water management is 41% in the top environmental themes, and healthy river and ecosystems is in the top 38% of the environmental themes in 2023. And if we have a look at the top social themes, this is probably no surprise that 48% in the top is healthcare, public health and medical products, and that has been, you know, at top of mind, especially coming out of COVID in the past couple of years. 33% is employment, support for employment and local businesses, and 28% of the top themes are green, property, social and community infrastructure. So in the research by RIA, in addition to asking Australians about the top environmental and social themes they consider when investing, they were also asked which issues or activities they want to avoid in their investments. So a total of just over 1,000 Australians aged 18 and over were surveyed, and the sample was gender balanced, equally split across the 4 generational categories based on age. And this research has been run from 2017 to 2021. And the results reveal that about half of Australians want their investments to avoid a range of negative impacts. And the top priority remained focused on avoiding animal cruelty and human rights violations, and a marked increase among those who seek to avoid environmental damage compared to 2 years ago, as we can see in the figure here. Sentiment towards other issues stayed the same or slightly decreased. So interestingly, while renewable energy and energy efficiency is a top theme of interest for the majority of the population, 53% of the population, only 35% of the population want to exclude investments in fossil fuels. So perhaps here there is an education gap on the environmental impact of fossil fuels. So as an investor, it is really important to ask yourself, how does an investment fund's principles align with yours? What are your values and principles? And are you willing to put your money into a company that doesn't align with your values and principles? So very interestingly, we have a look at some statistics of our expectations when it comes to ESG investing. So this is again referring to RIA's data in their 2022 Values to Riches report. So 4 out of 5 Australians are expecting their bank and super funds to be invested responsibly and ethically. And for over 80% of the population, this means that their investments deliver a positive impact to the world. Almost 2/3 of Australians still agree that responsible and ethical super funds and investments perform better in the long term, similar to 2 years ago. 74% of Australians would consider moving to another provider if they found out that their current fund was investing in companies engaged in activities not consistent with their values. That one was very interesting. 3 in 5 Australians would be motivated to try and save more money and invest more money if they knew that their savings and investments made a positive difference in the world. This is an 8% increase from 2 years ago. Australians are increasingly concerned about social and not just environmental issues when investing. And for 3/4 of Australians, social issues are important when they think about investing their money. And this is up from 64% in 2020. The vast majority of Australians want the finance sector to act upon climate change, and 5 out of 6 Australians believe it's important that their super fund or bank or both commit to reducing the greenhouse gas emissions and setting targets to reduce those emissions. And 81% of us want to see this reduced emissions pledge to achieve net zero by 2050. And of course, concerns about greenwashing remain prevalent among Australians, with 72% of the population concerned that responsible investors engage in greenwashing, particularly the younger generations, so 80% of Gen Z compared to 66% of the baby boomers generation. And this actually stopped 65% of Australians from switching to an ethical provider. And of course, we still demand more transparency and more authentic, responsible investment practices. And 4 out of 5 Australians would like their super fund or investment provider to communicate the impacts that their investment is having on the planet. So let's look at the themes related to ESG and the impact that this investment approach has on the environmental, social and governance issues. So ESG puts emphasis on employee sustainability and human capital productivity, which leads to improved company performance. Companies that invest in ESG initiatives demonstrate greater control over risk management, strengthen their brand image and create better connections with customers, partners and employees. And ESG not only makes the business favourable to investors, but it can also improve the overall financial performance of a business. So to keep up with ESG programs, companies must track their key metrics such as energy consumption, raw material usage and waste treatment that can eventually lead to reduced energy bills and cost reductions. Companies that stay compliant with ESG-related regulations also have less exposure to fines, penalties and other business risks, which can positively affect their bottom line. The affordability of ESG investing, that will depend upon the fund and the investment that you invest in. So some funds can charge you higher fees for an ESG investment, than for non-ESG investments. The cost of ESG investing will depend on how the fund manages the investment. So this will depend on whether an investment is actively managed. So if so, this may cost you more as the investment manager is tracking the performance of an investment and making those buy, hold and sell decisions about their assets in it, with the goal of outperforming a designated benchmark. And if the investment is passively managed, for example, then the product replicates a particular index, or it invests wholly in another financial product, and this may cost you less when compared to an actively managed fund. So it will depend. But overall, ESG investing has become more affordable, enabling people to invest in line with their values or ESG interests, while also receiving investment returns without needing to trade off the ESG investing for investment returns.
It's interesting on that one, Bianca. I remember it would have been about 8 years ago or something when a client actually said, I really want to invest ethically, but they need to be ethical about their fees, and we need to get, fees from how much it costs. With one of the super funds that was saying that they were focusing on ethical investments, and ironically at that time, their fees as a super fund were the highest out of every super fund's fees, and the returns back then were not, I guess it's that supply and demand, but the returns were also then not as good as what, as what now we're seeing, and why, you can actually make a positive difference and have a positive financial outcome, whereas 8 to 10 years ago that wasn't the case.
True, very true. Thanks, Shannon. So let's take a look at the impact of climate change. So 97% of scientists agree that climate change is being caused by human greenhouse gas emissions, and 1 degree of warming has already resulted in devastating impacts across our world. The Paris Agreement is a legally binding international treaty on climate change. It was adopted by 196 parties at the UN Climate Change Conference in Paris, France on 12th of December 2015. And its overarching goal is to hold the increase in the global average temperature to well below 2 degrees Celsius above pre-industrial levels, and pursue efforts to limit the temperature increase to 1.5 degrees Celsius above pre-industrial levels. So to limit global warming to 1.5 degrees Celsius, greenhouse gas emissions must peak before 2025 at the latest and decline 43% by 2030. So more and more countries, regions, cities and companies are establishing carbon neutral targets. So zero carbon solutions are becoming competitive across economic sectors, representing 25% of emissions. So this trend is most noticeable in the power and transport sections, and has created many new business opportunities for early movers. So by 2030, zero carbon solutions could be competitive in sectors representing over 70% of global emissions. Climate change can impact financial institutions through physical risk, transition risk, and liability risk. So physical risk can include direct damage to assets or property, through extreme weather events, which can result in lower asset values, increased insurance claims, and supply chain interruptions. Transition risk, that can include policy changes, social adaptation, technological innovation, which can impact pricing and product demand and defaults on loans. And liability risk, that can include stakeholder litigation and regulatory enforcement, which can disrupt businesses and also can result in penalties from litigation. So if you do have an interest in ESG investing, then you may have heard about the terms SDG, or Sustainable Development Goals. So the SDGs are a collection of 17 interlinked objectives designed to serve as a shared blueprint for peace and prosperity for people and the planet, now and into the future. So these SDGs are a collection of our world's most pressing sustainability issues, And these SDGs recognise that ending poverty and other deprivations must go hand in hand with strategies that improve health and education, reduce inequality and spur economic growth, all while tackling climate change and working to preserve our oceans and forests. So companies contribute to the SDGs through their business activities, asset allocation and investment decisions. Excuse me. SDGs are global goals set out by the United Nations, whereas ESG is a rating system used by companies to measure their environmental, social and governance credentials. So your values may align with, or you may be interested in, for example, affordable and clean energy. So for this value or SDG interest, you would then research companies and invest in those that align with your chosen SDG theme and invest in that company. Investment screening, that's a more complex step further into ESG investing. And by actively eliminating or selecting investments according to your values, beliefs, or specific ethical guidelines. So the underlying motive here could be religion, personal values, or even political beliefs. And investment screening can be applied as negative screening or as positive screening. So investment screening uses a set of filters to determine which companies, sectors or activities are eligible or ineligible to be included in a specific portfolio. And these criteria may be based on an investor's preferences, values and ethics. For example, a screen might be used to exclude the highest emitters of greenhouse gases from a portfolio, as in negative screening, or to target only the lowest emitters, as in positive screening. So screening can be a deeply personal choice, and different things will bear different weight for different people. So if you are keen to invest in the ESG space, have a think about what causes are important to you, whether it be climate change, gender equality, education, health and well-being, or a combination of a few of these. What can you get out of the ESG investing, you know, the growth, income, goals, and also helping the environment along the way? And who else can benefit? Society, environment, and our future generations. So if we have a look, here's some examples on the screen of some positive screening. So that's the process. Positive screening is the process of finding companies that score highly on environmental, social, and governance factors relative to their peers. And these companies can then be selected for sustainable investing portfolios. So if your values align with, or you're interested in a certain area, then you may have this area positively screened in to your investment. So for example, if your value or interest is in clean technologies, then you might look to positively screen in clean technologies by investing in companies that provide renewable energy and electric vehicles. So negative screening, that's the process of finding companies that score poorly on the environmental, social and governance factors relative to their peers. And these companies can then be avoided when constructing your portfolio. So divesting removes harmful industries from your portfolio that you do not align with. We've got some examples on the screen here for you. And while this growing trend of exclusion is great to see, it's just the beginning. It's not actually meeting the breadth of customer demand. So in 2022, the top 2 issues consumers wish to avoid in their investments were animal cruelty and human rights abuse. So let's look at the top ESG themes that people find important by their generation. So it's interesting to see here, as you can see on the screen, we've got our Gen Z, Millennials, Gen X and Baby Boomers generations. Interesting to see here that the top 2 priorities across all the generations are actually the same, being the renewable energy and energy efficiency, and also secondly, healthcare, public health and medical products. Then we look at the top ESG themes that people would prefer to avoid, going through Gen Z, Millennials, Gen X and Baby Boomers. And here we can see that Each generation has slightly different themes that they would like to avoid, but there also is some commonality in the top couple of themes as well, with animal cruelty and human rights appearing. So impact investing, that's also a method of ESG investing. Now, impact investing refers to investments made into companies, organisations and funds with the intention to generate a measurable, beneficial social or environmental impact alongside a financial return. So a basic goal of impact investing is to help reduce the negative effects of business activity on the social environment. And corporate engagement is also another method of ESG investing. So corporate engagement is where a fund may select investments to influence changes in a company's conduct on ESG related matters. So for example, as a shareholder of a company, an investor may seek to bring about change by voting at meetings. So in other words, this could be that you purposefully invest into a company that does not align with your values, with ESG values, with the goal of realigning the company's values towards ESG investing by voting your views in the company's meetings. Greenwashing. Let's talk about greenwashing. So greenwashing.
There's been a bit in the news this week. About greenwashing, actually. It's a number of companies getting in quite a bit of trouble over that. Yeah.
Yes. So greenwashing, that's the process of conveying a false impression or misleading information about how a company's products are environmentally invested. So greenwashing involves making an unsubstantiated claim to deceive customers into believing that a company's products are environmentally friendly or have a greater positive environmental impact than they actually do. So beware of greenwashing. The potential for funds to overrepresent the extent to which their practices are environmentally friendly, sustainable or ethical is referred to in the market as greenwashing. So Australians are demanding more transparency from their providers, and we are attuned to the threat of greenwashing, which prevents 65% of Australians from switching to an ethical product. 77% of those who are considering investing in responsible investments within the next 1 to 5 years would be more likely to do so if the product was independently certified or labelled as authentic. So interestingly, Australians appear to trust super funds more than banks when it comes to delivering on responsible investment promises. And basically, investors need solutions that they can trust. In a 2021 report by Morningstar, it was found that millennials, Gen X and baby boomers all had similar preferences for owning sustainable investments. With this, greenwashing has become an increasing issue for ESG investing. And in 2021 report, The Economist studied the world's 20 biggest ESG funds, and it found that each of them held investments in fossil fuel producers, while others held stakes in oil producers, coal mining, gambling, alcohol and tobacco. 58% of CEOs admit that their companies are guilty of greenwashing. So it is important to do your due diligence on your funds that you are going to invest in to ensure that they do actually align with your ESG values. Alongside with your ESG values or interests, it's also important to include your goals, your investment timeline, and what funds you are investing with to give you an overall picture before you invest. So it is still important to consider your risk profile when ESG investing. Determine your goals for the investment, determine your timeline for the investment, think about what risk you are willing to accept comfortably with your funds being invested. And will your ESG investing be inside super or outside super or both? Will all of your investing be in ESG investment space, or would you prefer to have some ESG investments alongside some other non-ESG investments So these are all considerations to think about and discuss with your financial advisor when you are investing, or to do your due diligence if you are doing the investing yourself. So as mentioned before, Australians appear to trust super funds more than banks when it comes to delivering on responsible investment promises. And 7 out of 10 Australians believe that super funds that claim to have a positive impact actually do have that positive impact. So there are 6 perceived barriers preventing more than half of Australians from switching to responsible investment super funds. And these include a lack of independent information, lack of credible options, lack of time, the cost, the difficulty in switching, and the lack of money in super. So on a positive note, 73% of people recognise that responsible investment super funds look at options that standard funds do not. 70% of people trust that super funds that claim to have a positive impact do have that positive impact. And 74% of people believe that ethical or responsible super funds do have a positive impact. And like any investment strategy, ESG investing comes with its own risks and rewards, pros and cons. So if we have a look at the pros, ESG investing helps investors align their investment strategy with their values, with the ultimate goal for many investors to be long-term wealth. Many investors don't want to do so at the expense of the environment or their community. So ESG investing is a way for them to evaluate which investments will not only give them a strong return on their investment, but also help them do some good for our world in the process. One of the cons, as mentioned before, is greenwashing, and that can make it difficult to know what companies are actually sustainable. So some companies are guilty of using dishonest marketing tactics to convince consumers and potential investors that they're making a positive impact when they're not. So the onus really falls on you as the investor, or working with your financial advisor, to review the company's records and determine if the company is sustainable. ESG reports, they disclose data and explain the impact and added value of a company in 3 areas: environment, society, and corporate governance. ESG reports contain summaries of quantitative and qualitative information and are complemented by performance analysis in these 3 areas to provide stakeholders and investors with an insight into the goals, achievements, and the impact of the business. So I'd now like to welcome Shannon back to go through the next steps of ESG investing.
Sorry, I couldn't find my little button for the unmute. So I hope that's given you a bit of background then on ESG and what it all means. We obviously hear a lot of these terms, but what does it actually mean from a practical perspective? And how do you go about implementing it? How do you know if your investments are ESG? So there is the ESG certification. You can look for those certifications. There's the Responsible Investment Association of Australasia. And there are other companies, your S&P Global, etc., that will actually put that information out there. Stock research companies like Morningstar also offer ESG ratings, but it is a matter of actually doing your research on it. I know when we work with clients, we use a particular software that obviously the clients won't be then licensing their software themselves, which actually helps us get down to a really granular basis as to what are all of the investments in the company. Because a company could invest in another company and then a few subsidiaries down, there may be other investments that you're not wanting to support. So it is worth actually doing the research. I think as time goes on, there is going to be better reporting requirements as to what companies are going to do it. So I guess when you're looking at implementing ESG investment choices, you want to really decide on how do you want to build your portfolio? What is that going to look like? What is the criteria that's going to be most important for you. It is really challenging to satisfy and not be investing in anything, anything on those lists that you're not wanting to invest in, and what's going to be your percentage that you may tolerate or not tolerate, and where you feel stronger about different areas. And if you've got that criteria, that gives you the ability to be able to then make those choices, and then be able to then settle on the investments that align with your goals, and making sure that that's consistent, so that you, especially once you've done that research and going down to those levels, to make sure that what you think you're investing in is actually what the company is investing in, because it's as there's the greenwashing, and also it's just the layers of entities as you go down. So I guess we'll turn it over to if we've got any questions. Let me just see if I've got any come through. I can't see any questions at the moment. Does anyone have any questions in particular at all? If you've got any questions? No, maybe you've covered it so well, Bianca, like, maybe you've covered all of that. So we've got no other questions. Now, this recording will be on our YouTube as well. We do also have other sessions. We record all of our webinars, so feel free to go onto our YouTube, and if you've kind of watched everything on Netflix, it's another good alternative for you, especially on the winter months like what we have at the moment. Now, what we do have coming soon, I'm very excited about this. We actually have a very guest speaker, Jodie Fitzgerald. Now, Jodie is in an incredible, I guess her title is Head of Institutional Portfolio Management. So she decides on the portfolio structure of the investment funds of the large companies, and then obviously filtering down to, to clients of ours. And one thing I really like about every time I hear Jodie's going to be presenting, I almost feel like I'm a girl fan. I am there listening. I don't know if anyone's listened to a lot of the banks when they talk about their economists, and you can't understand everything that Jodie says. You will understand everything, even though it'll be a complex topic. She presents it in such a way that all of us people can understand it. And so I'm really looking forward to, we've been fortunate enough, I think I begged her quite a bit to be able to go and get a webinar with her to go through really what are the outcomes in this volatile market? How can you actually still get, positive returns? We're looking at the market at the moment. Every day it's going up and down. So Wednesday, 9th of August, register to hear Jodie, and she will actually take, especially we would have had another Reserve Bank meeting. So we'll have the Reserve Bank meeting. Everything that she said, we caught up for dinner with her about 2 months ago, and everything she said that was going to happen is happening. Things happen the next day. So anyway, do register for that. She is absolutely brilliant, and she speaks in absolute normal, what she calls it, people language, normal people language. So it's not like going to one of those economic updates with the banks where you don't understand anything they're saying. So yeah, do join us for that. Otherwise, thanks for joining today. Thanks, Bianca, for pulling all of that together. And I hope you learn a bit more about ESG investing and how you might be able to make a more positive difference in the way in which you're investing, whether it be in your super or personally, so that it is, kind of we're leaving a good footprint, I guess, with the planet going forward. So thanks very much, everyone, for joining, and I hope to see you on our next webinar.
Thank you, Shannon. Thank you, everyone.
Excellent. Thank you.